it has been very much in their interest because they know what's going on. They've seen what's going on. They have been confused by it, but they now find that they are in a position of extreme danger with the physical stuff disappearing and the paper markets potentially losing control of the pricing. They want to close their positions down. And so consequently, they have moved very, very aggressively to do so. The bullion banks have been able to control the market, basically by flooding the market with gold-denominated credit. Whenever the buyers come in, it just takes the buyers out. Buyers get tired, and then suddenly you bang it and you take out all their stops. I mean, it's a wonderful game, so long as nobody actually stands for delivery. That, however, has come to an end.
Open interest has notably declined on the COMEX market, dropping from approximately 520,000 contracts to around 430,000. This decrease suggests that banks are actively closing their short positions due to heightened risk associated with the dwindling supply of physical gold. Historically, gold producers hedged their future output by selling gold futures contracts, particularly during periods of high prices, such as 2011 and 2012. During those times, these hedges constituted a significant portion of the market's short positions. However, currently, producers are less inclined to hedge, with net short positions falling below 50,000 contracts. This shift pressures swaps and complicates banks' efforts to suppress prices. According to Alasdair Macleod, the demand for physical gold is evident from COMEX delivery data this year, with approximately 253 tons delivered compared to the United States' annual production of about 167 tons. This surge is straining physical gold supplies. Gold prices soared to above $2,450 per ounce in May due to strong purchases by central banks, notably the People's Bank of China, PBOC, which seeks to diversify reserves and hedge against currency risks. China led global public institutions in setting new records for gold acquisitions in Q1, increasing PBOC's holdings from 62.64 million to 72.80 million troy ounces. This reflects growing Chinese demand amid high savings rates and limited investment alternatives, potentially amounting to 75,000 tons of gold, disrupting traditional market dynamics. To manage risks, Alasdair notes that bullion banks are actively reducing their exposure by scaling back positions and closing unallocated gold accounts. Banks typically prefer dealing in credit rather than holding substantial physical gold reserves due to associated risks. The withdrawal of physical gold from the market poses significant challenges to the paper gold system. Bullion banks' ability to influence gold prices through the issuance of paper gold is diminishing, potentially leading to greater market volatility and higher prices as physical gold becomes scarcer and more highly valued. Alasdair believes this shift could fundamentally alter how gold is valued and traded globally. We will present clips from Alasdair Macleod's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Paper gold is credit, which you can create out of thin air if you're a bank. If you've got a banking license, you can create gold contracts, whether it's futures or forwards or whatever. The one thing you don't want to do is to take settlement. The swaps on COMEX have got themselves very, very short. And I'm sure that there are bullion banks in the same position in the London market as well, which of course is quite a bit larger. So it has been very much in their interest because they know what's going on. They've seen what's going on. They have been confused by it, but they now find that they are in a position of extreme danger with the physical stuff disappearing and the paper markets potentially losing control of the pricing. They want to close their positions down. And so consequently, they have moved very, very aggressively to do so. And if you look at the open interest on COMEX, it has virtually collapsed from something like 520,000 contracts down to, well, I think, yes, last night we were looking at something like 430 odd thousand contracts, which taking it as an overbought, oversold indicator is very much an oversold indicator. So, and the structure of the market has also changed against the swaps. The swaps basically have, it's mostly comprised of bullion bank trading desks. But the producers are not hedging. In the past, when you had the spike up at 1900 back in 2011, 2012, the producers were short of 200,000 contracts, over 200,000 contracts. And that, if you like, meant that the short position in the market makers was not nearly as great as it is today. So they were able to hit the market very hard, and they drove the price down from 1900 down to something like 1,050 over a period of 3 years. The swaps cannot do that today because the position in the producers is that they are net short of less than 50,000 contracts. The rest of the short side in the COMEX market is being borne by the swaps. And if you look at what's been going on over the last 2 or 3 years with stands to delivery in the COMEX market, this is effectively taking physical liquidity out of the market. I mean, huge tonnages are being taken out. This year so far, since January the 1st, up to last week, roughly 253 tons of gold had been stood for delivery. And this is a non-delivery market. And compare that with the annual output of America. The annual output of the United States is around about 167,000 tons. That's the estimate for this year. Already this year, 253 tons has been stood for delivery on COMEX. That is the extent of the draining. Now, the situation for the establishment is getting worse, and they are becoming aware of this. And that is because of the massive level of savings in China. At a household savings rate of roughly 35% of GDP, that's the equivalent of $6 trillion at current exchange rates. It's not going into property. It's not going into stocks. It's going into bank deposits. And increasingly, it's going into gold. Now, $6 trillion is the equivalent of 75,000 tons of gold at current prices. I mean, the one thing that your Treasury Department in the bank will not permit is for you to load up on gold because, banks are not in the business of owning stuff. They're in the business of dealing in credit. And, if you've got a position, just close the bloody position. Don't go out and try and buy gold. So you can see that there is a hell of a problem which is built up over a long period of time through habit as much as anything else. I mean, the bullion banks have been able to control the market basically by flooding the market with gold-denominated credit. Whenever the buyers come in, it just takes the buyers out. Buyers get tired, and then suddenly you bang it and you take out all their stops. I mean, it's a wonderful game, so long as nobody actually stands for delivery. That, however, has come to an end, and it's also coming to an end quite dramatically in silver.
The U.S. Federal Reserve opted to keep its key lending rate steady at 5.25 to 5.50% after concluding a 2-day meeting, as stated on Wednesday. Initially, policymakers had anticipated implementing 3 rate cuts, but later revised their forecast to just 1, citing ongoing inflation levels that persistently exceed their target despite recent signs of easing. This adjustment in rate cut expectations was a surprise, especially following a government report in May that revealed a more substantial decline in consumer inflation than economists had predicted. Alasdair noted that although financial markets found reassurance in the Fed's post-meeting statement, which highlighted progress in their battle against inflation, the core challenge remains unresolved. Inflation remains above the desired 2% level. Rather than further reducing rates, there is now discussion about raising the target rate to 3% or higher. Meanwhile, the extended period of low interest rates has prompted businesses to accumulate significant debt. With higher rates looming, managing this debt burden could pose challenges. Consequently, banks are tightening their lending criteria, making it harder for small businesses to secure loans. Instead of lending to businesses, banks opt to invest in short-term government securities to finance deficits. However, Alasdair points out that this strategy needs more to stimulate economic growth and diminish available capital for private investment, complicating efforts to achieve a robust economic recovery.
The economic consequences of the current level of interest rates are extremely serious, and the Fed will have an eye on this and be very concerned about it. So they've got this problem. How do they deal with it and inflation, the inflation problem at the same time? Now, I think that perhaps a consensus, with the US economy turning down, with inflation still continuing, et cetera, perhaps if they can sort of just muscle in a few cuts in interest rates, then consumers won't rush out and buy, sort of just put their money into goods and services and therefore drive up the prices quite so much. Perhaps a result of lower interest rates might end up taking a bit of inflationary pressure out of the steam out of the system. I can see them pushing that sort of argument, but it doesn't actually cut any ice. I mean, the person you want to listen to in America is Jamie Dimon. Dimon makes it quite clear that the outlook is very dangerous. He says he's pessimistic on the economy. And what this means is that the banks from the top downwards are restricting their lending. They cannot, in aggregate, cut their balance sheets. So what they're doing is they've diverted their lending from the private sector. And if you go around America and talk to small and medium-sized businesses and ask them about, the ability to borrow money from the banks, I mean, they will tell you in no uncertain terms, there ain't none. It's almost impossible. Instead, this money is being funneled into short-term T-bills, which has been basically funding the government's deficit. And the government's, you've had, there's a headline, a couple of months back, that the government debt increased by $1 trillion in 90 days. It's a pace that is accelerating. But the reason that it's happening is because all the liquidity in the economy is tending to go away from the private sector into funding government spending, which is non-productive and inflationary. So the inflation dragon is actually still being fueled. On top of that, with the foreigners not buying dollars and at the margin selling, as we've seen with the Chinese central bank, with the People's Bank of China, then that means that the borrowing along the yield curve is going to get increasingly difficult. And you're going to see interest rates, bond yields, far higher out along that yield curve.
As banks cut short positions amidst dwindling physical gold, and with increased demand from central banks like China's, the gold market may see higher prices and increased volatility. This shift could reshape global gold trading dynamics, emphasizing physical gold over paper gold. Share your thoughts on Alasdair's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.